San Diego. Sponsored by Wilsey Asset Management.
Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we're talking to local business leaders about the topics that are important to you, your home, your family, your health, and your money. And the following segment is brought to you by Wilsey Asset Management. So if you're trying to buy a home and you're struggling to come up with a down payment, you might be tempted to tap into your 401k. Is that a good idea? Brent Wilsey is here to break it down for you. It's not.
Yeah, sorry to say it's not a good idea. It sounds good. Gee, I want to get that home and so forth. Yeah. And this is coming up because the administration, the president, is trying to help younger people. People don't have their first home yet, get a home. Yeah. And it's just, and housing's a big part of the economy. That's the other thing too, is that, you know, housing goes down, it's going to hurt the economy somewhat. But it's not a good idea. I mean, the 401k, your IRA should be left alone because those are for retirement. Yeah. And we know Social Security is not going to benefit you. It's not going to be a full thing for retirement. There's no more pension plans from companies, and well, few do, but most do not. So it's your 401k. That's your retirement account. You should protect that and grow that. And I know people do want to buy a home, but taking money from the 401k is not a good option. And there are options too. We can borrow against a 401k, another one that's not a good idea.
So are the rules going to change then? I mean, is there a proposal that would pass some legislation that would make it different in the way that we do this? Because you point out, you can borrow from your 401k. It's
right.
Just not a good idea to
Just
do.
not a good idea. And yeah, they're trying to come up with different ways to do it. And let's talk about the borrowing, because, and I'll give you another idea to looking at as well, but the borrowing, people say, oh, well, I can borrow, and the number you can borrow is up to $50,000 or 50% of your 401k. Well, that sounds pretty good. And the one that I love hearing, which I hate to hear, people say, the uninformed, oh, this is great, I can pay myself interest, what a great thing. And it's not a great thing, and I'll tell you why. Because what you're doing is you might take that money from your 401k that was earning maybe, hopefully 9, 10% invested properly. You're going to pay yourself interest of maybe 6 to 7%. So your compounding on the long term is not going to be there because it's a lower rate. And the difference between 6 and 8, 9, 10% is huge on long-term compounding. The other thing too, you pay that interest, you think, well, this is great, I'm paying myself interest. Well, you're using after-tax dollars. You do not get a tax deduction for putting that interest in there. However, when you pull from your 401k, from your IRA, you'll pay tax on that interest you put in there.
Really not a good idea.
Yeah, not a good idea at all.
And of course, you're sacrificing what it is that you'd get with the market gain and this compounding interest over the course of years and decades, right? That's what you really want out of a retirement account. We're starting to lose sight of what a retirement account is all about. Yeah?
And then another idea came out from Kevin Hassett, who's the director of the Economic Council. He said, well, gee, what we can maybe do is use from the 401k is use that money for, you know, from the equity of the home, about 10%. So part of your 401k would be equity from your home, so you could use that money that way.
Okay.
Well, that sounds pretty good, and yes, the House will appreciate it. And I do want to point out, I do not believe that the growth going forward the next 17 years on real estate will be anywhere near what it was the last 7 years. We had very low interest rates, a lot of different factors there. Right. But with that said, you're going to have now maybe 20, maybe 30% of your 401k. It's going to be in your home equity. Well, when you retire, you can't sell off 0.5% of your home equity to pay your income every month. That's not good. So you either have to sell your home to put the money back or have a lower retirement. So they're trying very hard to come up with these things, and it's just, you know, the economics, sometimes you can't move them that way. I mean, the economics are, we had a big boom on the housing market, now it's a lower boom, houses are expensive, you know, and it's just these things. And many young people, you know, that bought houses a few years ago, they're really not that thrilled because they forgot, they like going out and playing and traveling. Well, now they got to stay home, they got to cut the grass, they got to, you know, trim the hedges, they got to paint the garage door, all these maintenance things, and they can't afford to have somebody else do it, so they have to do it. So sometimes home ownership is not really that great of a deal.
Yeah, the reality of home ownership is something you need to consider. Of course, this is so hard in San Diego too, but I mean, ultimately, this is a bad idea for anybody, even if the home values, I mean, you move to Wyoming, you're still going to have the same challenges, right? Just don't do it.
Still have the same things. And again, it sounds good, but it's just something that, you know, what's the saying? It sounds too good to be true, it probably is. Right. And it used to be different in the olden days, because the older days, you know, people would stay home, but now younger people want to go out and travel and have fun. So.
Okay, Brent, appreciate it. You'll find Brent online at smartinvesting2000.com, and we'll be right back.